going to start with a little story which is not on this presentation. So a few years ago, I was looking at the whole lending space. This is back in 2009, 2010. And a friend of mine just joined this company involved in car financing. I knew nothing about car financing. And he goes, you know what, we've got this car financing company for subprime customers, and it's a big market because Advantage Finance pulled out of the market. And I said, who's Advantage Finance? So it turned out they were a £1 billion company financing car loans. And back in 2008, of course, when the financial crisis occurred, they pulled out of the market, leaving a big vacuum. So a friend of mine went and said, I'm going to start this company and build a car financing company. Now, back in 2009, 2010, if you were trying to raise money for a subprime anything, you were kicked out of the building, because that was like a taboo subject. You didn't talk about subprime or anything in the non-prime sector. Lloyd's, RBS, Barclays just didn't touch that. And that's where there was the arbitrage, that's where the opportunity was. So I got them funding. Part of the funding that you alluded to over the years that I've raised came from Germany. It came from a German bank to fund a Portsmouth-based car financing company. Why? One single thing made the difference: tech. Technology made this German bank in Munich that had never been to Portsmouth fund over 4 years about 130 million pounds worth of car financing, because they had this one singular thing that made it click for them. There was a device they installed in the dashboard. It connected your ignition to the engine. Every month you made your monthly repayment of your loan, you got an SMS code. You took the SMS code, you put it in that device, your car worked. You missed a payment, you got a couple of warning shots, you still missed your payment, guess what? You ain't got the code, you can't start your car. And what happened? It's like your mobile phone. If you don't pay a bill, you pay that right away because the pain point gets too high. So tech can be your best friend. And part of what I want to show today is that that world that we play in is changing largely to tech. And what we have to do is embrace it as your best friend, or as we say in the Valley, your best frenemy, because it's both a friend and an enemy. So this is the future of motor insurance as we see it. I'm going to start with a bit of an audio play. Hopefully that is audible enough. And it's your interaction with insurance in the future.
Hi Siri, please find me car insurance.
I have found 3 of the lowest quotes for car insurance matching your details. Female driver, 25, living in London, frequent driver. Would you like to continue?
What is the cheapest quote?
The cheapest quote is £600. Would you like me to go ahead with the purchase?
Yes.
That's all. I'm using your stored bank details. I have emailed you the confirmation. Is there anything else you would like help with?
No, thank you.
There you go. So you have right there device-centric, voice-activated, AI-based virtual assistant, basically becoming a replacement for my first point of contact. So bye-bye aggregator, bye-bye walking to high street. I'm going to be talking to Alexa and Siri and whoever else comes along, who's going to be talking to me while I'm making breakfast. It becomes seamless in my day. I don't have to make the extra effort, because most people are not going to buy insurance the way they buy a Gucci bag. They just want it done. They just want the price, they want the best coverage, and my AI is going to tell me that my profile matches the following options in the market. Do you want to execute? They can transact it, they can collect it, they can put my digital record of my insurance in my wallet, on my phone, and that's before my envelope's made. So insurance distribution will have to take account of this first touch point. I'm going to sidetrack a bit because we are not an insurance broker, and people wonder, what are you doing in this space? We're a financing company. But we're looking at where this insurance market's going, and we think insurance in many ways will become like Netflix. There's been some references to Netflix during the day here today, which is interesting because we're not an entertainment conference, we're an insurance conference. But Netflix provides a model whereby people, particularly millennials, buy things based on convenience. What's easiest for them to consume, what's easiest for them to access, and what's most digestible to them. And that is an app-based purchase where I can switch on and switch off as I like it. So we're working with InsurTechs who basically want to take this model out to the market and say, we want to offer insurance by the month, by the week, by the day, by the hour, by the mile, And you've had references earlier in the day about people saying, if you actually pro-rata that out, that's very expensive insurance. So I made a reference to £7,000 for insurance based on a unit of a weekly cost of insurance. If you extrapolate that into 52 weeks, it's a very expensive insurance policy. But that's not the point. People will switch it on and off based on convenience. And as the market gets more competitive, those monthly subscription prices will also normalize. They won't be as high as they are when the unit cost is so high. So we've come along and said, you know what? Let the InsurTechs offer what they want to that's most apt at what the consumers want. But in the background, we will prepay the underwriters so they get their full annual premium up front. That's what the financing business for premium finance will evolve to. Because we're not just doing plain old loan agreements, we're actually prepaying the underwriter to make insurance more affordable. That's the premise of premium finance. So we don't have to stick to the current loan agreement formula. You can just make it a different version of that by allowing for monthly payments, and at the back end fulfill the underwriter's requirements for an annual premium. So we do that through a direct model. We private label and white label that app, or if someone's already got an app there, we just embed our services in there. Because we think the future is changing. We know that insurance is going to become much more on demand, and that therefore will disrupt the current distribution model. Because people are going to buy them at 2 in the morning. They'll buy them when they're overseas. They'll buy insurance when they want to buy it from a device that they're familiar with, talking to nobody except perhaps an artificial intelligence voice. That's what we have to go for, because that's a big market. The millennials represent the biggest single consumer group in our lifetimes. Their spending power is going to exceed that of the baby boomer generation. In the US, it's already surpassed that as of 2018, and it's coming soon to Europe. So if you want to capture that future, you've got to go where they want, because it all goes back to being the customer's best friend and mapping out the customer journey based on the way they want to be ridden across their journey. That spending power is what's coming to you across the world from that largest single consumer group that we've witnessed in our lifetime. Now, we know that tech is disrupting this, right? It's no surprise that more than half of the brokers think that the industry will be disrupted by tech. No surprise there. But let's see how. Typically, the customer owner is that person who owns customer data. If you own the data, you own the customer. And hence, if you ever look at M&A transactions, one of the key things they'll look at aside from financials is who owns the customer data, who's got the repository of that, who's got the marketing rights to the data, who can upsell and cross-sell. Because as you know, from brokers to insurers, you want to upsell and cross-sell products. So owning that customer data is critically important, and through that customer data, you therefore own the customer. Now, the brokers in our industry have been that touch point. They've been the ones who are like the retailers selling insurance, commercial or personal lines, to enterprises or individuals. That's about to change. And it's being attacked by 4 ends, or it's being partnered with at 4 different directions. Big tech, InsurTech, EV manufacturers, and ride sharing in the motor industry, the motor insurance industry. Because that customer data is now being garnered by and collated and owned by these new set of entrants, therefore they could soon be owning your customers. That's what you have to watch out for. So let's look at the big tech. These guys are obviously deep-seated, lots of experience, because they control our apps. Most of us have some form of interaction with Amazon or Google or Apple based on our app store or accessing other services through our phone. And it's no surprise that Amazon is now getting into the insurance space. There's been noise about it for many years. They've actually made some moves there. No surprise that Google invested in an insurance startup company called Oscar. Of course, a big check there for $375 million. And an unknown figure, but in the millions again, into Applied Systems, who I know are here, and they've got standouts, as you were talking about it. But why would Google invest in a software company in insurance? That's the question. Look at Apple. They've also partnered with Aetna to offer a new app called Attain. And the prediction is that they could have more revenue than almost any new single line by next year. That's a big figure, 15 billion, from insurance. We don't think of Apple as being an insurance company, but guess what? We didn't think of Nokia as being a phone company either. It used to make tires. So companies can move and evolve depending on where the market's going. By owning that customer access point, these guys are the best positioned to take advantage of that. Let's look at the next set, InsurTech. When this opportunity is spotted, of course, entrepreneurs get in that space. And entrepreneurs are backed by angel investors, venture capitalists, private equity to go into that space. No wonder 4.4 billion is gone. And that's as of 5 years ago when we started tracking it. And that's obviously gone up since 2016, 2017. We got funded in 2017 by venture capitalists. We're not even on this chart. That was 4.4 to swing to those years there. And it's across the board, across geographies. If I'm in Tokyo, which is where one of our funders is, you see InsurTech there. I was in India 2 months ago, there's InsurTech there. California, obviously this one's there. So this is a space that you're seeing new entrants because the opportunity size is so big, and the ability to disrupt it is premised upon the fact that I don't need to rely on traditional channels to access the customer. New points of access are coming for me to access the customer data, and hence the customer itself. When investors look at the space, they see, of course, this is a space that's very inefficient. It's the same method used by tech industry to tackle other inefficient industries. And here, looking at the industry expense ratio, this is of course in P&C, but again, it's not that dissimilar from other forms of insurance. It is waiting to be disrupted. It happened with, of course, other industries. Remember Kodak? Remember Borders? I can go so on and so forth. Sears and retail. There's tons of examples of this inefficiency being disrupted. And of course, look at the market cap of Tesla, which passed like 100 billion recently. That's a sign of where this industry is going when people get lethargic. And that could be insurance next. Let's look at the other players that are out there. EV manufacturers. Really interesting place. Tesla's offering insurance that could be 20 to 30% lower than existing customers. Jaguar Land Rover has launched CARP, again an all-inclusive price for a vehicle with insurance. Why? For two reasons. One, cars are getting smarter. It's not just telematics, that's like 1.0 of cars getting smart. You get data that shows driving records, etc. Now I've got other things. I've got autopilot. I've got stability. If you've seen the new Cybertruck that Elon Musk launched, I've got bulletproof metal. Now the problem is, and that's the second part of why these guys are getting into it, your traditional insurers don't know how to price that. They don't know what it's going to cost to fix a Cybertruck that's got a dent. Who's ever fixed bulletproof trucks before and has mass amounts of data? No one. So Tesla, of course, steps into that and says, why don't we do it? Because we've got all these things that we will be gathering data on. It's all about big data and AI, and they can price things that the traditional insurance companies can't. And guess what? Tesla's got access to some pretty deep pockets. And they're closer to your customer because they're getting all that data, so there's a vacuum they're tapping into. Similarly with Jaguar Land Rover, you can look at the same with GM, same thing of course with Volkswagen and BMW. So you have new competition coming from electric vehicle manufacturers because cars are getting so smart and data is getting so rich, and they're harnessing that. Remember, data equals customers. Lastly, of course, ride-sharing companies. A bit of a surprise, but not necessarily. If you looked at the filing from Uber in 2017 in their IPO prospectus, they put aside $3 billion for insurance claims. Insurance is a big deal. They actually said our future growth is premised upon the insurance industry's reaction to our new play of ride sharing. It's such a critical part of their growth. So they're getting into this because they're the node for the electric vehicles in the future. If you think about autonomous vehicles, well, who'll be operating them? Uber and Lyft and Bolt and other companies like that. Insurance will not be necessarily premised upon the person driving it. It'll be predicated upon the vehicle itself. Hence, auto manufacturers are getting into that space, and auto manufacturers are collaborating in the same friendly fashion that I mentioned before with the operators. So GM invests in Lyft. Aviva's got a partnership with Lyft in Canada. And don't forget, big tech's also collaborating because Alphabet's just a parent company for obviously Google. And why would Google invest in Lyft? Why would General Motors invest in Lyft? It's that convergence of those four partners coming together saying, that's going to be a future place to monitor what's coming in the industry, and insurance can be sold at the point of sale as an insurance on demand. So they've created their own ecosystem, right? You've got big data getting the data, cars are getting smarter, ride-sharing operators are the node for all that, but where's the broker in all of this? Remember, customer data is a customer ownership. So the future looks potentially bleak in some ways, but potentially there's also a lot of points for collaboration. You want to be talking to these guys. You want to get in bed with any one of those four, if not all of them, because that's where the touch point will be for the customer. So what do brokers do next? Partner with insurers that are smart. They're the insurance companies that are partnering with the Teslas, with the Lyfts, with the BMWs of this world, because they're the ones who kind of get it. Partner with EV companies. For every Tesla, there's 5 other ones that are starting. and there's no reason why you can't get into bed with them. We have as one of our shareholders, by the way, Rakuten, which is the biggest shareholder in Lyft. They're also the biggest shareholders in Cabify, another operator there. They get a lot of data. We've been trying to do premium finance with them, but the problem is there's not many insurance companies that play in that space as yet. There's an opportunity. And you piggyback their growth. It's actually probably a better way to go about it because they're going to grow, you're going to back them. And of course, invest in tech. If the InsurTechs can do it, surely bigger established brokers can do it. Because you get smarter access to data, and data means your customers. So you look at all these guys who are playing, these insurance companies I referred to before, they are already partnering and offering information through Siri, through Alexa, through Google's Assistant, but they are not, at this point in time, allowing them to buy the insurance. They get access to it, but they're not taking to the final point of getting a contract. That's why Tesla stepped in. That's also your window, right? That's the window of opportunity for brokers, because that final consummation of that dialogue through a contract is where a broker plays. That's where the broker can be the preferred partner that's got years of history, years of data, and a brand that is recognized as a broker that you can utilize and capitalize on while the opportunity exists. Now, it's also not surprising that within these InsurTech companies, you have insurance companies or reinsurance companies as investors. So they're seeing this. Munich Re is very active in this space, as is we have other insurance companies out of the US. Mass Mutual is another one that's got a venturing program to tap into the space. So partner with them, because the future is shifting from that traditional paradigm, which was mass categorization rigid. You created schemes around certain demographic sets based on historic data of accidents for women between the ages of 20 and 30 in Brighton. You could aggregate that, create a scheme, and the brokers were able to sell that. Well, now that's changing because it's getting completely individualized. I do not need to be part of a larger sum and a category if my driving record is different from another woman who's 25 in Brighton. Because I'm a safer driver. I don't drive as much. I drive during the day, not at night. So telematics is giving me that. My car is getting smarter. I can put autopilot on and go to sleep at the wheel if I have to. I'm not saying you should, but you could. At the same time, I'm using my Apple device to access pricing. I might not even be clicking on it. I might be talking to the device while I'm driving to get the best rates. So you want to move for the broker industry in that space and talk to these people. That's where some of the big opportunities are going to come out over the next 2-3 years, because that's where flexibility, on-demand, and individualization is playing. So the future mode of insurance distribution, from the way I see it, is here, moving away from there. That's it for me. Thank you.
Yeah, thanks, Bundeep. I think there's lots of food for thought there. I'm sure there'll be some questions. I mean, I guess the obvious one is, for many brokers, maybe trying to get on the phone to Tesla is going to be a bit tricky. And I just wonder, on a smaller scale, how maybe people can get involved. If they see these trends, how they can adapt.
Actually, I think that in some ways we create barriers in our own minds. It's not impossible to get to them. It's not that difficult. So when Brent Hogan set up lastminute.com, he very cleverly registered Priceline.co.uk. Right? Because Priceline was one of his competitors. So when Priceline came into the UK, guess who they contacted? Brent Hogan, saying, "Oh, we need to buy this URL." So if you think ahead and say, okay, if Tesla's going to come here, what are they going to need? Are they buying out spots for recharging stations on the side? Are they talking to municipalities? You think ahead, you can find ways to basically not quite ambush them, but kind of get your antennas out. So when they're coming here, you'll be talking to them. But if you want to reach Tesla, give me a shot afterwards. So same with Jaguar Land Rover. It's owned by Toyota. That's not that difficult to get a hold of. They're one of the most accessible Indian corporates. So I think sometimes these barriers are in our space. So one of my shareholders is a common shareholder with Tesla.
Right.
So it's not that difficult to get there.
Great. So we've got some questions from the floor, Bundeep.
Shock and awe worked.
So, I guess another question is, you talked a bit about how premium financing kind of sits in the background. in terms of enabling insurance on demand and things like that. I just wondered if you could explain that in a bit more depth, because I guess one of my thoughts was that surely that puts quite a lot of risk in your hands, because if you've underwritten the risk, but actually out of a total of 365 days it's only taken on for 200 days, let's say, then surely the risk is then with you.
Correct. So it's a good question, because one of the attractions of premium finance is the low loss ratios, because the ultimate risk is that of an insurance company that gives you a refund. Well, if you keep that premise, what you want to do is partner with a broker, could be a traditional one or an InsurTech that's offering this on-demand insurance. So let's take our Netflix model, monthly subscriptions. At the back end, you have someone like Aviva who's underwriting it. So we would have a three-way agreement, a trilateral agreement between the broker, Aviva, and us that says, okay, ABC brokers offering this monthly service. We get paid every month by the end customer who's pre-paying a month in advance. If that person doesn't renew, that triggers a termination event, and we get a pro rata refund from the underwriter.
Right.
So our time on risk is zero, and that's dictated by a trilateral agreement with the underwriter, ourselves as the financier, and the broker is selling it. We don't necessarily need to have a loan agreement with the Consumer Credit Act dictating that. We can do that by a trilateral agreement. I'm sure there's some regulator people here we can talk later, but that's the premise. And therefore you actually make it arguably cheaper for the customer because you've got lower onboarding costs.
Okay, but presumably, but for Aviva, then the risk is moving to Aviva in that.
Which is the same as it is today, right? Absolutely the same, because as long as we're only financing the pro rata cancelable insurance.
Yeah.
Right? So we can have a conversation in 5 years from now when the augment rate fully comes to it, you see how political liabilities get, we may revisit that. But at this point in time, it's pro rata fully cancelable without third party liability deductibles that you see, for example, in Poland or some other markets.
Let's say, any more questions for Bundeep down here? No? Okay, well, great. Thank you very much, Bundeep.
Thank you.